Well, welcome to today's show. And our guests on the show that are not MPC reps are not affiliated with MPC or Rick Saylor Financial. Enjoy the show. Well, good morning. I'm Rick.
And I'm Eric.
And we are your transparent wealth management hosts.
Welcome to our show.
Well, Eric, welcome to Cincinnati, buddy. It's, again, we're a little chilly here, but I understand.
Snow's on the ground
what
still.
were you just telling me that Sunday, it looks like spring may be breaking and 40s, almost 50s, and by 60s next week?
Yeah, that's what we like here in Cincinnati.
As long as it comes and it stays. It's the up and down that I don't like.
Yeah, it's, when snowing 4 inches on Wednesday and it was, 40 degrees on Tuesday? We got all that rain. So it's up and down here. That's why we live
I have
in
gotten
Cincinnati.
in one whopping outing of cross-country skiing, which I dearly love. This is one of the things that just absolutely kicks my butt, but it's a heck of a workout. But I love it. I love it. So I know a couple things that we've got an interesting guest on the show today, and we're going to be talking about something that's not really talked about, and it's really off the beaten path. Focusing on a little bit different focus than what the rest of the talking heads talk about.
That's right. And it's we do have a guest, and it's very exciting. I'm excited to do the show with him here today. It's gonna be fun.
It's our first time, and Charlie, of course, dialing in from New York City, but we'll have him on here in a little bit. But just to get to a couple of housekeeping items, one of the things that we hear so much about, what people love about Straight Talk Clear Decisions is really that simple, straightforward, no nonsense. We're going to make it plain for people. It's not simple. It's a complex process. Otherwise, everybody would be gazillionaires.
That's right.
Right? But we know that that's not the case. So we really try to make it understandable so people can apply it to their situation and really every one of the four pillars. So this end-to-end holistic process that we're so fond of in the industry makes so much sense because things are integrated. They're working well together rather than independent parts. And when I refer to the four pillars, I'm really talking about the investing aspect. We're talking about taxes. We're talking about protection, insurances, and talking about estate planning. Now, from an investing standpoint, we are both fee-based and commission-based. We just can't be doing the same thing on the same dollar at the same time.
Yep.
So again, I don't understand why in our industry they're still debating that, because it really should be about whatever the client's situation is and solution.
The second pillar is taxes, both planning and preparation. Tax code is not going to get any simpler or cheaper for the majority of us. So doing the proper planning ahead and then filing on time and filing correctly is going to be ever more important going forward.
I think about the risk management sector. We have partners in the tax area because obviously we can't wear all these hats. And we have partners that are separate and unrelated to our company, but we collaborate with them, CPA firm here locally. And then on the insurance side, our partners cover everything in the that arena, from life insurance and the long-term care, the new form of long-term care that actually has some interesting twists on it. Disability, health insurance. I want to tell you the Affordable Care Act is brought about a whole new world of changes and Medicare planning and all those aspects.
The last pillar is estate planning. We have both elder law and estate planning attorneys, partners that do that to make sure your estate is in order. So when that day comes, your assets, your legacy gets passed on to your loved ones, not the hospitals or the courts or the attorneys. So making sure your estate is in order today to make sure it gets passed on as efficient as possible.
So you know what? The topic today is about investing, but any of these other topics, feel free to go on our website, straighttalkcleardecisions.com, and there are a lot of other free white papers, reports. There are some services that are offered. There's a tax efficiency review. I know everybody's got taxes on their mind now. Certainly can go on there and take advantage of that, they go back, I think, 2 years.
Yep.
And look to see what possible mistakes were made. You get a do-over on up to 3 years of refiling. If you've made a mistake, and you certainly want to, planning is optional. You can plan going forward to make sure you don't step on those. In the risk management field, pertaining to insurances, we say, get an insurance audit if you wonder. It's been a couple years. Let them check it because making sure you got the right amount of coverages and you're paying a fair amount for it, is all key to that. And in the end game, it's last but not least, that you make sure that your money, your wealth goes to your legacy, goes to your loved ones, and not some court's attorney or some hospital.
Yep.
So straighttalkcleardecisions.com. Search around the website, check that out. A lot of past shows on some of those topics. We've had guests on, so good stuff there. And I would be remiss, Eric, if I didn't cover some of those lovely disclosures that are required. You know that National Planning Corporation is our broker-dealer, and the opinions that we're going to express today are our opinions, and this is educational in nature. Don't take this as doesn't constitute investment, tax, or legal advice, and certainly always consult with qualified financial, legal, tax, real estate professionals. Certain statements that we may make today, certainly our opinions, may be forward-looking, and of course, no past performance, any promise or guarantee of future results. Nobody has a crystal ball. Although we'd love to, if we find one and you've got one out there, let us know. We buy that at a discount. Some of the stuff we talk about has, what I want to say, historical views of it with the group HS Dent that we dearly love and follow, and demographics, and we may refer to some of that today.
Yep. Well, let's introduce our guest, Rick.
Excellent. Well, the today's show, we're going to be talking about inflation rotation investing. We have with us Charles Bilello, who is a co-author of a paper called An Intermarket Approach to Beta Rotation. He did that along with Michael Gayad. They are with the Pension Partners Group, and they won the 2014 Charles H. Dow Award on that paper. Very impressive, Charles. Welcome to the show.
Thanks, guys. Good to be with you.
And you're calling, it sounds like you're right in our studio here, but I know you're in New York. How's life up there?
It's snowy and cold, which I think a lot of your listeners will be familiar with over there in Ohio.
Yeah, we've got them. Actually, our show runs global. I was told by we've got listeners in China.
Okay.
Yeah, so it runs the gamut. It runs the gamut. They broadcast out of Phoenix, so it's pretty much anywhere and everywhere. So anyhow, as we talk about this, why don't you first of all just give us a brief background, Charles, on what kind of who you are and your credentials, where you come from.
Yeah, sure. So my background is really in investment management, different areas within the spectrum. So I started out in the credit markets, investing in bonds, mortgage-backed securities, and CDOs and complex instruments like that. Over time, I moved over into different areas within the spectrum, including equities and multi-strategy areas within the hedge fund industry. And more recently, I joined Pension Partners, which is a firm that really takes a different approach to investing, and a really tactical approach where we're focusing on risk management and protecting capital. And we do that through two mutual funds and two strategies. One's an absolute return strategy called the Inflation Rotation Fund, and the other is an equity-only strategy, which is called the Beta Rotation Fund. So really, it's a different type of firm, and my background really is really focused on asset allocation and risk management, and that's really what we do and focus on here at Pension Partners.
Excellent, thank you for that. So we're gonna drill down on this different view, and we know, of course, I have to say, no past performance, any promise or guarantee of future results, and so no one strategy has this forward-looking ability. But I find it very interesting, and we have been, shall I say, fans of Pension Partners and followers for what, Eric, 2.5, 3 years?
Yep, about 3
We've
years.
been following Ed Dempsey and Michael Gayad, and a lot of good information. Definitely smart guys. I mean, I love the information that we get, and it's definitely just a different approach.
And this is an example of that different approach. I know Michael Guy had an article in Market Watch this morning, Charlie, and it said, "This is incredibly exciting times for us as our research suggests that nearly all alpha and outperformance over long cycles doesn't come from being up more in the market, but rather by being down less and sidestepping those big downturns." And that's really what you guys are. It's not about making more money when the market's cranking. It's really about when those downturn comes and how you can kind of foresee when a potential downturn is in the future.
Right, that's exactly right. So, we've done a lot of research. You mentioned one paper there, which was called the Intermarket Approach to Beta Rotation. We also did another paper after that focusing on the Treasury market. But, what all of our conclusions in our studies have shown that it really is that protecting on that downside. And I think today, we've had 6 consecutive years of gains in the markets. Very few investors are worried about that downside. It's been a long time since it's occurred, and people are feeling, very optimistic about the future, which is great. But I think investors have to remember, in the long term, it really is managing that risk on the downside that makes all the difference. So, in particular, we look at really 2 main areas of the market that really signal, what that future volatility is going to be about and when you really want to manage risks. And the first area is the utilities sector, which I think very few investors look at. It's known as a boring sector. It's a high dividend sector, but most people don't realize that it's really the most predictive sector of the market. And the reason for that is twofold. One, it's highly interest rate sensitive. So when utilities move, it's telling you something about interest rates. The other thing is that utilities are highly regulated, so that their revenues are not really affected as much by the ups and downs in the economy. So when utilities move, they're telling you something about volatility, and they're telling you something about interest rates. And what we found is when utilities are doing better than the market, it tends to precede a period of higher volatility where you'd want to manage risk. And the opposite is true when utilities are underperforming the market. You want to take a more aggressive stance. And that's how our strategies are really built, around that concept of shifting between a more defensive stance and a more aggressive stance based on our research and based on these signals.
Well, that's a good overview and a little more drilling down, which we'll continue to do in the next segments here. We just got a couple minutes in this first segment. But one of the things I wanted to toss in there, Charlie, is when Michael was in the office here in Fairfield a couple of weeks ago. We had a great visit here. But one of the things that I heard him say is that, this misfocus on the upside, what they call the alpha side of the market, certainly sells. It's the sex that sells, that sells the headlines, and everybody wants to chase the S&P 500, and yet so few really capture the upside. The S&P finishing at 13%, Eric, last year, but what Michael tell us is that the U.S. Treasuries did 25%, but you didn't hear that.
The 30-year did a little over 20%. So
yeah, but that's not as sexy, I guess, because bonds are kind of boring. It's like watching grass grow and paint dry. And I guess people just don't like that. But I like 25%, even though there's no guarantee of that. But, I mean, this type of thing, that the component that focusing on, I think what we would term, and maybe you would too, Charlie, the risk-adjusted rate of return in a portfolio is what we're going to be focusing on coming up in the next segment. And we got 2 more segments to come. So you're listening to the Straight Talk Clear Decisions radio show with your no-nonsense hosts, Rick Saylor
and Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, Rick Saylor here. Have you considered the options for maximizing Social Security? 3 things I can tell you about it. It cannot legally go broke. It's an all-or-something system, and smart planning involves strategically integrating this with the rest of your income choices. Don't make the $100,000 mistake by not planning appropriately. Consider retirement income, survivor, and spousal benefits, because there's 81 options for couples and only 9 for singles. Options and strategies like file and suspend, or claim now and claim more later. The difference between age 62 and age 70 is 57% more income for life. So be sure and ask your advisor today about Social Security planning.
Rick Saylor, smooth financial sailing for the best part of your life.
Well, welcome back. You're listening to the Straight Talk Clear Decisions radio show with your no-nonsense money host, Rick Saylor.
And Eric Hamburg.
And we have a guest today, Charles Bilalo. Bilalo from the Pension Partners Group and the 2014 Charles H. Dow Award winner on that paper, An Intermarket Approach to Beta Rotation. And be sure and check us out on Straight Talk Clear Decisions. If you've got a question, and we have enough time at the end of the show here, info at Straight Talk to cleardecisions.com. Easy for me to say. Info at Straight Talk cleardecisions.com, or call us at 513-454-9999.
Yep.
And you can just get that out there. Now, Eric, take a second here. You know, on our website, there's a lot of other things. People can go on there and sign up for a absolutely free subscription to our e-newsletter.
Yeah, so if you go to straighttalkcleardecisions.com, on the left-hand side, you can sign up for our weekly e-newsletter. We send out once a week, typically on Wednesday afternoon, Wednesday evening. However, the e-newsletter says a couple of different things. Number one, we break down the financial speak that you hear on TV and on the radio, and we break it down to simple to easy to understand terms so you can understand how it affects you and your family, not how it affects the rest of the world. We have a economic calendar of the week, so if there's big reports coming out, jobs reports, unemployment reports, we tell you when and what time they're coming out. We have our speaking schedule, so you know our next radio show, what the topic is, what time it airs, and and some of the live speaking. I know Rick teaches at University of Dayton coming up here.
UD's coming up
UD.
in March?
March. Well, we're in March, so here in
19th.
about a week or two it starts. And he does a college. It's an adults program called OSHA Lifelong Learning Institute, OLLI, and on the website it'll tell you what it is, where it's at, and what time. We also have a health tip of the week, green tip of the week, a quote of the week, a golf tip. We like golfing here, so get on the website. We also have a lot of our free giveaways that we have on each one of our shows, and you can visit us on our Facebook page, Rick Saylor Financial. Like us, follow us. You can get a lot of the giveaways there. And we're on Twitter. And as well, I think Charlie and Pension Partners is on Twitter as well. So follow us, and you'll get a lot of the free giveaways, a lot of the free offers we're willing to share with you.
We're on Facebook. Like us on Facebook. We'll like you back. LinkedIn, I know a lot of and we send out notifications of what our show is going to be every week on there. So we'd love to do that with you, keep you up to speed. I know they podcast. Brad over there at Voice America, they podcast and iTunes our shows, so you can get them right on your. You don't have to listen when the show's live if you want to go back and capture something. So let's jump back into this inflation, rotation, and investing idea with Charlie. Charles, you actually like Charles, don't you? As opposed
Charlie's good.
Charlie,
Yeah,
okay.
Keep it informal.
I just say, hey, call me anything as long as it's not too late for dinner. I like that.
Sounds good.
So I know one of the things that when Michael was in the office, Charlie, we were talking about, he was talking about when you get into this arena of forecasting, and there's so many people trying to make forecasts, and everybody out there wants to know who has the crystal ball. Weathermen are some of the most accurate forecasters in the 3 to 4 day period of anybody in a recent study. You get much beyond that, and like Eric was talking about 60-degree weather next week, may not happen, buddy. That's beyond the 3 to 4 days.
Can hope.
And I look at that in relation to the market. That is certainly the case when we think about that. And, a lot of things that are going on, you may want to address this one that we had talked about before, Charlie, with the, borrowing from the future to satisfy the whims of today, and being aware that, a passive, this whole idea, we've seen a very, very low period of volatility in the last, year and a half, 2 years. And I think this is a benign period in history, and it's not the norm. And people may be lulled to sleep and think that a passive, 60% stock, 40% portfolio is going to, continue to perform like it did in the past.
Right. I think this is really the most important issue for investors that they're facing today, and it may be difficult to comprehend because it's so abnormal in the historical context. But when we think about a portfolio, which most investors have, a mix of stocks and bonds, how do you get to a certain level of returns, right? Let's start with the bond portion of most investors' portfolio. They have 40% bonds or higher if they're getting closer to retirement or they're going to need the money sooner. Well, the average bond fund now is yielding around 2%, which is pretty much the lowest in history. And if we look back at history, at what the best predictor of bond returns looking ahead, the next 7 to 10 years, it's that beginning bond yield, which makes some sense. So at 2%, you're really looking from the bond portion of your portfolio. It's going to be very difficult to get much more than that unless you're expecting interest rates to be even lower than today, let's say 7 to 10 years from now, which is unlikely in our opinion. So that's the bond portion. If we move over to the stock portion of the portfolio, unfortunately, things aren't too much better there because stocks in the long term trade on valuations. So if we look at metrics that smooth earnings over a period of time, the most popular being what's known as the Shiller PE, where you take the last 10 years' earnings, you average those earnings, and you say, what's the current price of the market? Well, if we look at where it is today, it's about 28 times the average of the last 10 years' earnings. That would put the market's multiple at higher than any other period in history except for 1929 and the late 90s heading into 2000. So what has historically happened from these high levels of stock valuations in the past is significantly below average returns, usually in the low single digits. So when you combine the two, you're really at a tough position for a passive buy and hold investor, where they're probably looking at a blended return in the low single digits, which is going to be very difficult as compared to their expectations.
Well, and I think one of the things to add into there, what most investors will commonly refer to is PE ratios or price to earnings ratios, looking at a price of a stock to the earnings that it's spinning off. And in the market, there's no question. I think everybody's heard the narrative that the stock market is trading at an all-time high. From a demand and growth aspect, this is not natural that the market has risen, and a lot of this has happened on stimulus. And so, the question is, we start to look, we're forward-looking. You had made the comment that with interest rates being at all-time lows, I don't think they can go below zero, although we've seen that in Europe where it's punitive, and they are charging institutions to be sitting on capital. Really, I don't think we're seeing that. But the question is, how is that going to affect a portfolio as we go looking for, and how important is risk? If somebody, Eric, loses 50%, what they got to make to get even?
100.
Yeah, I mean, you can't, if you lose 50, you can't make 50 to get back even. You got to make twice as much. So, as you get into that, manage your expectations and risk in retirement, that's the focus of the game. We'll capture what we can in a good risk-reward relationship, but don't go chasing the S&P because you may be disappointed.
It's been a few years now, right? And investors always forget, right? In 2000 through 2002, the S&P 500 lost 51% of its value. In 2007 to 2009, it lost 57% of its value. So here we are today, again, 6 years into the bull market, and no one's thinking that such a thing could happen again. But again, things are changing here. The Fed policy that was put in place in 2008 is likely coming to an end this year. They're likely to raise interest rates, and that's going to change the market environment. And I think few investors are aware that in 2010, the Fed explicitly, through Ben Bernanke, wrote an op-ed in the Washington Post where he said he wanted to pursue this quantitative easing, which is essentially buying Treasury bonds to lower interest rates. And he said he wanted to do that, and he wanted to keep rates at 0% for years to come in order to lift stock prices so that people would feel a wealth effect and spend more money. So one of their main goals was really to take the future returns of the stock market, what you normally get, let's say 8 to 10% a year, and say, let's bring that forward to today and hope that investors spend some of that money to get the economy going. Now, we haven't actually seen that second part of it, but we have seen the first part, right?
That's a good
so we
point.
have stock markets at all-time highs and these elevated valuations. But again, the Fed is now shifting that policy. So if we're to believe that that stock markets are elevated because of this monetary stimulus, then the opposite has to also be true, where at least it's going to be in the next 6 years much more difficult when the Fed starts raising interest rates.
And I know one of the conversations we've had a number of times here on our show is about we're big fans of the demographics and the work of H.S. Dent and how that potential cause and effect component that 46-year-olds in America are the peak consumptive spenders. The United States is the number one consumptive nation in the world, maybe not the biggest consumptive, unit. That's the European Common Union. But however, as that narrative goes on 46-year-olds, that all this stimulus and all these actions and all this Fed, lowering interest rates, printing money, buying bonds, Eric, and yet we still don't have 46-year-olds coming up. We're still declining because there's 92 million baby boomers, and we call those between 1932 birth rates and 64. And like a train, the engine of the train, the front of that wave, and 92 million people are 83 and the caboose is 51. And your generation, the millennials, start turning 46 in 5 years from now. So even with all that they're doing, it may not work.
Yeah, that's what they've done. The government has perverted the system by printing all this money, and it's thrown a lot of those fundamentals out the door. Like Charlie was saying, now that we're coming off this easing period, some of this volatility that we haven't seen a lot of volatility the last 4 or 5 years because the stock market just keeps hitting new high after new high after new high. And that should be an alarm to some people because we need these corrections. Corrections they're needed in the market because it allows investors to buy in. If the market just keeps going up and up and up because we keep printing money in the U.S., at some point the market has to come back to fundamentals. The volatility has to start rearing its head again. And
in our conversation with Michael, Guy, when he was in the office, was that very component that we're starting the first of the year here. We start to see a shift to fundamentals. Now, in the next segment, in our last segment of the show, we're going to have Charlie initially address, are we in the late stage terms of the bull market that we've been on in an economic cycle? I mean, can it go up forever? Is this a new norm or this volatility returning, which is more natural? So that'll be a good thing to address in the next part. And if you want to get some of the details, we do have a very user-friendly white paper that is a approved version of the intermarket approach to beta rotation. And the idea is that when there's risk in the market, there's upside and downside in the market, and rotating between that versus just buying and holding, which is the large, strong case for active management.
Yep.
Because I think again, what we've seen in the last 6 years or so is not what we're going to see going forward. And I think if people are thinking that, they could be in for a very rude awakening.
And if you want to receive that free giveaway, give us a call at 513-454-9999. Go to our website, straighttalkcleardecisions.com, or go on our Facebook page or Twitter and ask for the free white paper, An Intermarket Approach to Beta Rotation.
Well, you're listening to the Straight Talk Clear Decisions radio show with your transparent wealth management hosts, Rick Saylor
and Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, have you heard about the new long-term care alternatives? Many of you may know how I managed my mother's care, and I took her through her money in the spend down, into the veterans benefits. My father was a 2-time Korean War vet, and right into the Medicaid. She started out at $2,700 a month in assisted living, and at the end of her life, 2 years later, was over $8,000. The three concerns I hear the most about long-term care insurance protection is that it's expensive, the premiums are rising, and I may never use it. Well, why don't you try what I did? I bought a life insurance long-term care. They can't cancel me, the premiums can never go up, and I can spend that death benefit before I die if I'm critically, chronically, or terminally ill. Be sure and ask your advisor today.
Rick Saylor, smooth financial sailing for the best part of your life.
Well, you're listening to the Straight Talk Clear Decisions radio show with your Straight Talk Money hosts, Rick Saylor
and Eric Hamburg.
And we have a guest here, Charlie Bilello from the Pension Partners Group today, and talking about some, I would say, really a process versus performance view of the market, because so much of what we see on CNBC and the talking heads, everybody is chasing returns and the sexy sizzle of stocks, and yet sometimes, as we'd mentioned in our chat with Michael Guyad, last year the S&P did the S&P 500, which is an index, of course, you can't directly invest in, but you see these a lot of times in your 401ks and your platforms, and that did about 13%, but you didn't see much print or press on the fact that the 30-year treasuries did 20 something, 25%.
Something around there, 25%.
So I mean, it's a little bit of, misdirection. And I don't know that you're being served justly if you're not listening to the straight version.
And Charlie, I know you mentioned, recent biases leading a lot of these investors today to believe the next 6 years will be just like these last 6 years that we've seen since 2008. Is this an unlikely scenario? Is this a late stage? Are we in the late stage of this bull market that we've seen, or is this something that can last a couple more years?
It's certainly something that could last, but just being objective about it, looking at the facts, we're at, on Monday it'll be 6 years into the bull market. That's past the average duration of a bull market, and the market's more than tripled over that time period, which is greater than the average advance. And in terms of the economic cycle, the average economic cycle is about 5 years, and we're past that as well. So the expansion began in June 2009, and we'll be at 6 years this June. So, could it go on for a few more years? Certainly. I think the question investors should be asking is, are we closer to the end than the beginning, and when do they start preparing for that end? Do they wait until things start to get bad, or do they preempt that? And really, our approach is to be proactive about it and get ahead of the downturns by moving in advance.
And I think that's why it's ever more important today to have a strategy, to have a proven strategy, because you're not going to time this thing. You're not going to change strategies when it's perfectly, when it's a perfect time, and you're not going to get out when it's perfect. However, if you have a perfect strategy that's going to work through the good markets and through the bad markets, that's what's going to get you to the ultimate end. It's not chasing these returns saying, the market's made this much money in the last 5 years, it's got to do it for the next 5. It's knowing the strategy, sticking to it, and doing what has worked in the past.
Right, because what tends to be more reactive is like, hey, when the market's doing really well, I'll focus on performance, and when it's doing really poorly, then I'll focus on process. However, just like the analogy we heard Michael use, which I thought was great, in the case of a car accident, most people hit the brakes after the motion of the accident's already taken place. You're not going to stop it from happening. And yet, people use that same analogy. Well, I'll catch this the next time. I'll just sell out before the downturn comes. But the problem is, if you knew that the accident was happening, would you not avoid it in the first place? So I would say, using that analogy, the process is more important than the performance, because when you follow a proven method that systematically over time tends to work the majority of the time. And we know within what they call the bell curve in standard deviations that, and I don't want to get too heady here, but within the norm, you have there's a mean or right in the middle, a dividing point, and then one standard deviation is about 68% of all occurrences, and then 2 deviations are 95. And once you get to 3 standard deviations, you're covering about 99.7% or 98.7%. So it's not 100%, but that's kind of a more process focus that you say, hey, if I'm within this range of possibility, then that's what I need to focus on. And we know, Eric and I, working on this side of it, Charlie, that when we're talking with people, that, it's surprising how many times that people, oh, yeah, I want that rate of return. And we say, well, hey, a minute, we've got this little quiz we want to give you. And oftentimes people are talking growth, but when we actually find out how they feel, sometimes, Eric, they come up in conservative.
Yeah, and it's just, they want the best of both worlds, and we get that. We're humans. Everybody wants never lose a penny and make everything you can. But in reality, that's not going to happen. And Charlie, that's why we've been following your guys, because you do have a proven process. You've got a proven strategy, but yet it's not going to work every year.
No, sure. You have to be willing to accept the false positives. If you look at historically the best strategies in terms of mutual funds or hedge funds, they're not outperforming every year, and they're not even outperforming over a rolling 3-year period 100% of the time. What they are providing is a better risk-adjusted return. And why that's important for investors is, for an investor to get the return of a strategy, they need to stick with the strategy. And if there's a significant volatility and there's significant drawdowns when they're losing money, they're going to abandon it. And when are they going to abandon that strategy? At the very worst time. So a lot of investors wanted stocks or more stocks in their portfolio. They demanded from their advisors in 1999 and then in 2007. They said, I want more stocks because we've had stocks just going straight up. They're saying the same thing today. But when it comes down to it, they want the upside, but they can't handle the downside. So they're asking for more stocks, but when we get that next bear market or correction, they can't handle it, and then they'll be shifting at the worst time, getting out of that risk. So it's really how do you mitigate that behavioral bias that we all have? You do that by having an asset allocation process, which you guys employ for your clients, and we offer products and funds and strategies that really mitigate that risk of selling out at the wrong time, mitigate that volatility, and manage that risk so investors won't be making that bad behavioral decision.
And I know one of the things we find fascinating over here, and again, for our listeners, just to make this really simple, that there's a lot of technical indicators in the market, and by following a process that historically is proven to be effective, although no guarantee, that looking at when certain leading indicators potentially could be taking over the market and watching how those move in, and as I say, conjunction with certain asset classes, stocks, bonds, whatever, that by paying attention to that actually anticipating when enough of those indicators line up, that you go ahead and make the move, even though the actual, I'll use my analogy again, that the actual accident hasn't taken place yet. Now, sometimes you're going to get that right, and sometimes you're going to get it wrong. But again, by adhering to that process, I think the key that we keep coming back on here is that, the process is about focusing on the fundamental of how those typically move and anticipating, because the damage of a loss, Eric, is far, far greater than those potential returns. And by mitigating that, and just getting a fair amount of the upside and what the market's willing to give us is the important part of that and the focus. But I'll also toss in one thing, if I may. I think what we're looking at with this period of time where that we've got the stock market having benefited from all this stimulus, but it's distorted it. And, when we look at it, we look at the average wage. We keep hearing this from a number of sources. That even though the stock market is going to all-time highs, the average worker has not, because they have the lowest. We are in the lowest real wage gross domestic product expansion period in history. And it's really an incredible. I've referred to it as a tale of two cities, where you're looking at the stats of the ultra wealthy, the 0.1%, and the gap between them and the average person has never been wider, because these policies have really been put in place to benefit the financial markets. And who has most of their assets in stocks? Obviously, it's the top 0.1% of people in the population. So I think it would surprise a lot of people, who look at the stock market and say, well, it's at new highs, things must be doing very well in the real economy. But the facts show that the real wage growth in this expansion has been the weakest and of any expansion in U.S. history, and real GDP growth growing at a little bit under 2% a year is also the weakest economic growth in history. So
the question, I think, at this point, and why the Federal Reserve is being pressured to start moving, is their policies really are not helping the real economy, because corporations are, instead of choosing to hire people or pay them higher wages or invest in their businesses, they're buying back record amounts of stock, they're paying dividends, they're doing things that they wouldn't otherwise do if you didn't have this easy monetary policy in place.
Yeah, and I think that's the crux of the whole matter. And the question is, when's the party going to end?
That's right. Well, let's get to the last segment, but before that, make sure you ask for the free giveaway, an intermarket approach to beta rotation. You can call 513-454-9999 or visit us on the web at straighttalkcleardecisions.com or on Facebook, Rick Saylor Financial.
So you're listening to the Straight Talk Clear Decisions radio show with your no-nonsense hosts, Rick Saylor
And Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, what about estate planning? An up-to-date will guarantees you're going to go through probate, and without, well, don't worry about it, the government will decide for you. The three enemies to an estate today are: number one, the federal inheritance tax; two, probate; and number three, income tax. So your choices here are: you can give all your money away. That might not be any fun. You may need it. Or you can create a trust to hold those assets. And remember, you don't have to own the assets to enjoy the benefits. So a revocable living trust can help avoid the expenses and costly delays of probate, and along with a living will, power of attorney, durable health care power of attorney. So be sure and ask about our attorney partners today for a free consultation.
Rick Saylor, smooth financial sailing for the best part of your life.
Well, you're listening to the Straight Talk Clear Decisions radio show with your transparent wealth management host, Rick Saylor
And Eric Hamburg.
Well, Eric, we're on an interesting topic today, and I know we never have enough time, so we're going to try to wrap up as much as we can in this last 10 minutes or so with Charlie Bilello from Pension Partners. And Charlie, you're a smart guy. I mean, writing papers. I do a lot of writing myself, but never anything on this scale. You guys, between you and Michael Guyad, won the 2014 Charles H. Dow Award winner on this paper, An Intermarket Approach to Beta Rotation. And I think when we think about that, really what they're saying is the committee is saying you're writing something interesting that they vetted and looked at, not a guarantee, but certainly had some work to them. And as we look at this as it applies into the market going forward, I think that's really, really the focal point. Because, where we have been stimulating here in an unusual period of time, looking at, we attribute this largely to demographics, Eric, as we look at baby boomers who numbered about 92 million. And if we looked at that like a train, that the engine is 83, and they're going to be spending down their wealth and using it on health care, and 51-year-olds at the caboose end of that train who are paring down their debt, we're saving more for retirement, and we're going to start spending more on health care related stuff, like my wife Kim, who just had corrective foot surgery and dental work and more prescriptions and everything else. So it's not stimulus kind of spending that helps us grow the economic engine, which I think it adds to that narrative of that's why we're in a slow growth period and the rest of the world is contracting. But now, Charlie, as we look at that and addressing that, it seems like everybody, I know Japan did it, they're 23 years and counting on their currency or whatever their low inflationary policy. China's been doing that forever, and they continue to cut rates, print currency. The United States has come through there, and now the European Common Union, ECB, has started to do theirs. So what's your outlook for this? And again, why is it all happening?
Yeah, I've written a lot, about the global currency war that's been going on here, because it really is the most important factor in the global economy. And why is that the case? And the reason really is similar to what we've experienced here, we're having the slowest growth recovery in our history, and many of the other countries around the world are witnessing the same thing. So with global growth shrinking, growing at a slower pace, countries are resorting to these tactics to try to grab market share. So if the pie isn't growing, you got to grab a bigger piece of the pie. What's one way to do that is, if you're thinking very short term, of course, is to depreciate your currency and hope that that will increase exports as your goods will be cheaper, and that will boost your economy that way. And second reason why they're doing that is also, again, the same reason why here we did QE 3 times and we kept interest rates here at 0% for 6 years, is to boost stock markets. Because if you're not having that real growth and you're having that demographic shift, you need to boost people's financial assets, or they believe that they need to do that in order to try to make up for the lack of growth and try to get people to spend money. But again, same as here, they're not seeing that second portion. So we're seeing that global stock markets are rising, same as they're doing here, because central banks are easing. But we're seeing at the same time global growth slowing. So Japan is in another recession. Europe is close to another recession, even though they're doing these record easings. So the outlook on this is really it's really become a tit for tat game where this year already 20 central banks have announced easing policies. So one after another, they're cutting rates, doing quantitative easing, doing various measures to depreciate their currency. And so what we've seen in the past 6 to 9 months is really a record collapse in currencies around the world against the U.S. dollar, because the perception is that the Federal Reserve here is going to do the opposite, and they're going to start tightening policy and raise interest rates. So what we've seen in the dollar index is really we've never seen before. It's been up 8 months in a row. It's really rising, and that's starting to have put pressure on U.S. company earnings. So in the fourth quarter of 2014, S&P 500 company earnings declined 12%. That was the largest decline of the expansion. So really what you have is a zero-sum game here, where if Japan and Europe now are going to take the baton, so to speak, and they're going to crash their currencies to try to stimulate their economies and their markets, well, then someone else has to be hurt. And in the short term, it's really the U.S. that's really bearing the brunt of it.
Hey, Charlie, on that note, let me jump in. And, if I guess the argument would come up, Eric, if you can do this, then why don't we continue to do it? I mean, what's the long-term effect? And I know for us in the United States, that's why you hear 18 trillion and counting. I mean, it's not free.
Nope.
Stimulus isn't free. It's got to come from somewhere. So we're accruing this backlog of debt, and we're not growing fast enough based on the population growth. So, I mean, we know the number one and number two drivers in the economy are the building, buying of houses, and the building, buying of cars, according to H.S. Dent, who's a well-published individual on the subject, and we've heard it from other sources. Somebody builds a house, it creates like 3 jobs and creates $90,000 in tax revenues and all these other, shall we say, tentacles of business related to that. And the second is automobiles. And we've seen, just extreme measures during an extreme period of time, and we're not by any means underestimating that, in our view, that this is the 1930s all over again with just different tools in our bag. And that it's going to have a different outcome. It's going to have a different effect. Yep. And I think, again, this all speaks to the narrative of it. There's no greater time right now than to be paying attention to the risk and in what we call, there is the psychology of investing, which is what do most investors tend to do? They buy when they feel really good and they sell when they feel really bad.
And if you don't know, if you're working with an advisor, you're working with a professional, maybe if you're even doing it yourself and you don't really have a strategy, your idea is just, well, we're buying it because it keeps going up and up and it can never go backwards. Maybe start asking questions. Well, what is the strategy? What are you looking for? Can this market truly keep outperforming on stimulus from the United States and stimulus from Europe? It's making sure you have that process and making sure maybe you kind of know what that process is.
So if this sounds interesting, intriguing to you, we've got some a great white paper for you, the Intermarket Approach to Beta Rotation, and you can request that simply by going to straighttalkcleardecisions.com. You can call us at 513-454-9999, or what's the other sources they can go to?
Facebook,
LinkedIn.
Rick Saylor Financial. If you go to Twitter, we have our own Twitter handle at Ricktirement, RIKTIREMENT. Charlie, our guest today, he has one as well with Pension Partners at MKT Outperform. So, get on, follow us. You're going to get, up-to-date information. You're going to get access to free white papers, free reports that we can send out in timely fashion.
And I think, in kind of wrapping this up, when we look at the, the risk associated, to the market trading at all-time high, and again, a focus on risk-adjusted rates of return. There's so many other pieces in the planning process. Making sure that you pull an income from a smart place, a place that's going to do less damage to your portfolio. Again, go to our website. We've got all those different white papers, reports. We've got different shows. We have, we write that e-newsletter. You get an absolutely free subscription, and anytime you don't want it, just click unsubscribe. We're not going to bug you.
Nope.
Lots of free stuff. There's something in there for everybody, even the kids.
That's right. Well, Charlie, we greatly enjoyed you on our show this morning. Any final parting words?
Thanks, guys. It's been great to be with you. No, just the big theme here is, again, think about having a plan, having an asset allocation plan, and really at this stage of the cycle, think about risk management and how, if you're prepared for another downturn.
Absolutely. Charlie, thank you so much. Stay warm in New York there. We're going to stay warm here, and hopefully the forecast that's more than 3 to 4 days out there is going to prove true for all of our sakes. Hey, you've been listening to the Straight Talk Clear Decisions radio show with your Straight Talk Money host, Rick Saylor
And Eric Hamburg.